So it looks like it's panic over. 5 days on from the bond market's big swoon last Wednesday morning. 10-year Treasuries are yielding 2.22%. That's actually slightly higher than the 2.2% they yielded at the beginning of last Wednesday before they shot all the way down to 1.86. Meanwhile, the S&P 500 is up some 6.7% from its low on Wednesday. That's arguably its best rally of the year. As for the VIX measure of equity market volatility, it's almost halved. It was 31 last Wednesday, it's now down to 16. Crude oil, it's important to mention, which arguably triggered all of this, hasn't particularly corrected. Its price has ticked up very slightly, but the trend remains distinctly downwards. Now, what is causing all of this? First of all, everybody seems to be expecting they're going to get more goodies from central banks, both from the European Central Bank, but also from the Fed here in the US in terms of easier monetary policy. Secondly, earnings season is producing surprisingly strong numbers, particularly if you look at the top line, the revenue of S&P 500 companies, excluding, of course, the energy companies. They're gaining some 4.9% per annum, which is hard to reconcile with a global growth slowdown scare. What lies ahead? Well, we have inflation numbers coming up, and as you can see from this chart here, the market bet in terms of the implicit forecast for inflation for the next 10 years from the bond market bet continues to be that we could be moving towards a deflation scare. Every time that break-even has dropped significantly before 2% in the post-crisis era, there has been a response from the Fed in terms of easy money. If we get a sharp drop below expectation in inflation, that will amp up expectations in that direction. Also, and perhaps much more interestingly, it's always possible that there will be a surprise on inflation in the other direction, and we will find people trying to position themselves for something which they're not currently positioned for, and that is inflation.